Hi, welcome to my channel. My name is Gil Rossi, investor and funds manager. Today I want to share with you Warren Buffett investment strategy taken from his shareholder letters, the one in 1975, 1976 and 1977. Those 3 years he has mentioned the strategy that he was using to invest the funds that were available from the insurance business. And since then, that's the strategy that he has been using. If you want to check those letters, in the investor relations page, you find letters from 1977 to 2020. But if you go to this link below here, it takes you to this book. And this is the digital version of the book in Kindle for $3. It has the letters from 1965 to 2020. There's also, this link will take you to a paper version of this book, which is up to 2014 only. I have bought this book because for me, learning from Warren Buffett, the best way to do it is learning from himself and not from books written about himself. And the best way to do that is either to listen to what he's saying either in the shareholder meetings or in interviews, or by reading his letters, which are these 55 letters that he has written. They are full of teachings, in investing especially, and business. So I encourage you, or I recommend you, if you want, to buy that book and take a look. So in the letter of 1975, he goes through his usual explanation of the business, textile operations at that time, and the insurance underwriting. And within the insurance underwriting, he mentions insurance investments. And in insurance investments, he gives us in a couple of paragraphs his investment strategy. I encourage you to now pause the video and take a read to the portion I have highlighted here, where he explains in a very succinct way his strategy, which is having a portfolio of equity investments heavily concentrated in a few companies. Those companies selected based on favorable economic characteristics, competent and honest management, and purchased at an attractive price measured against its value. He will maintain those for a long period of time. And then he says, with this approach, stock market fluctuations are of little importance to us, except if they provide a buying opportunity, because market fluctuations are not important, because what's important is the performance of the business behind that stock. Then in 1976 letter, he also goes through all the businesses, including insurance investments. And in insurance investments, he shows his portfolio, and you see that 51% of his portfolio is only in 3 companies. So this is a concentrated portfolio. At that time, 75.395 million was the total of the equities that he had invested, so in 1976. You'll see in a minute the portfolio as of the 30th of September this year is $327 billion. So from 75 million to 327 billion, all coming from just investing and compounding the investments that he started in 1965 or 1966 with the proceeds of what the insurance business was producing and with the float. So in this letter, he also mentions his investment strategy, and pause the video and read this highlighted text. But in essence, he's saying the same that what he said in 1975 letter, but he's adding one important thing. He's saying here, this first sentence, we select such investments on a long-term basis, weighing the same factors as would be involved in the purchase of 100% of an operating business. So when you buy a stock, you don't have to think about buying a stock, but you have to think on the business that stock represents. Even if you're buying a small percentage of that business, Buffett thinks as if he were buying the whole business. And he mentions the same factors, the long-term economic characteristics, the honest management, and the attractive price, but he adds the industry must be one that they are familiar in judging. So, and then he explains also why he has a concentrated portfolio here. And he says that it is because when you have stringent rules that your business or your investments must comply, then whenever you find that appropriate business, you have to buy it and hold it. And those opportunities don't come very frequently. So that, in a sense, is obligating you to have a concentrated portfolio. On the other hand, he has mentioned that, and it makes a lot of sense, when you have, let's say, 10 investments to take care of, 15 investments to take care of and follow, it's possible. But when you have 100, it's very, very difficult to know exactly what's going on in each of those investments. So it is safer to be less diversified if you take the approach of doing the due diligence and knowing that business very well, and knowing that that business is one that complies with your requirements. And now, going on a tangent, I'm going to show you the portfolio today as of the 30th of September. And you see that the 3 largest holdings are 66% of the portfolio. The 5 largest are 73% and the 10 largest 84%. If you see the whole portfolio, really, it has 45 companies today. But most of these companies, let's say from number 10 to number 45, they are less than 1% of weighing in the portfolio. And I think that these are investments from the other managers and not from Mr. Buffett. And here you can see what I mentioned a minute ago about the total value, 327 billion, plus he has 149 billion in cash. So these two add to roughly $500 billion in value for Berkshire, only his investments plus cash. So let's go back to the letter of 1977, which is the last letter I want to discuss today. And again, he goes through insurance underwriting, and then he goes to insurance investments, and well, he explains a few things that are worth mentioning, but I'm going to skip them now. He shows his portfolio, and again, he gives his strategy. Exactly the same 4 points that we saw in 1976 letter, but here he adds one concept that is worth mentioning. Pause the video if you want and read this text that I have highlighted. But in essence, what he is saying here is that he is not buying in anticipation of favorable stock price behavior in the short term. What he says is that if the business performance is still satisfactory, then he will welcome lower prices, because that will allow him to buy more of a good thing. So in these 3 letters, he explains his strategy. In all of them, he's saying the same thing, but he adds a little bit here and there. So I made a summary, and it would be: business or investment needs to be one that we can understand, with favorable long-term prospects or economic characteristics, or moats, sometimes he calls that, operated by honest and competent people or management, available at a very attractive price when measured against the yardstick of value to a private owner. And something I didn't explain, but when he mentions private owner, what he means is that there is no control premium. So when you buy more than 50% of the company and you have control over the management, you normally have to pay a premium. And that, of course, is not the value that he's measuring the price against. Because he says that in most cases, that control premium to him is not of any value, because he will keep the management and everything running independently. So he will be paying control just for nothing, nothing in exchange. And then in an industry with which we are familiar and able to judge. So this, I think, is in a nutshell Buffett's strategy. And if you have seen any of my videos before where I do valuations, you see that my structure of analysis follows, I mean, it's a copy from Mr. Buffett. I do the qualitative analysis, in which I do past performance of the business, which I am trying to understand the business. I check management, which is number 3. I check competitive advantages, which is number 2. And then I add financial position, which he doesn't mention, Mr. Buffett, specifically, but of course he has it in mind in one of these three factors. And then this 5th point in Buffett strategy, which is about the industry, is also, in my case, somewhere here. Then only if this is acceptable, I will go and do the projections and the calculation of fair value and see whether the price and fair value are an attractive proposition. So which is number 4 for Mr. Buffett. So I have in essence copied Mr. Buffett's strategy. And this strategy, he's been using it forever almost. He's been refining it. Before he put too much emphasis on the price. But now he puts more emphasis on buying on the number 2 and 3 probably, and 1, 2 and 3, the quality, and then if he pays a fair price, I think he is okay. If you have that investment strategy, your portfolio will follow. So you'll have a portfolio that will be concentrated, few outstanding businesses only. The stock market fluctuations will be of little importance to you, except as they may provide a buying opportunity. Then the scorecard on your investment decisions will be provided by business results over the long period and not by just prices on a given day. And then you will make no attempt to buy equities for anticipated favorable stock price behavior in the short term. So that would be the end of this summary of Mr. Buffett's strategy. I hope that you learned something, that you liked the video. If you do so, please give it a like. And thanks very much for watching. I'll see you soon for another video, probably in a couple of weeks. Thanks very much. Bye-bye.